Good afternoon, everyone, and welcome to our April edition of the Department of Mineral Resources Director's Cut. Our goal is to provide key updates on the state's energy sector, covering production trends and market outlooks, state initiatives, as well as key litigation. Topics will include industry activity, infrastructure developments, and ongoing efforts related to resource management and environmental stewardship. Additionally, we will provide insights on transportation and distribution and highlight key factors influencing the movement of oil and natural gas. This update is meant to offer a broad perspective on the region's energy landscape. Today we'll have presentations delivered by Nathan Anderson, Director of the Department of Mineral Resources, and Justin Kringstad, Executive Director of the North Dakota Pipeline Authority. And with that, let me introduce Nathan Anderson to get us started.
Good afternoon, and thank you everyone for joining us both online and in person. I know I do this every month, but I want to thank the team at the DMR for the great work and safety focus, both in the field, in our Bismarck location, Grand Forks, and our Heritage Center locations. We are in the final stretch of the legislative session and still involved in tracking a few very important bills, but can see the finish line. We will continue this month's Director's Cut with the new format as presented last month, and have done that and added a couple additional slides we believe to be relevant to the efficiencies in the industry, such as the longer lateral trend that we're seeing. With that, we'll jump into the data. I'll note that the April's Director's Cut will cover production numbers for February of 2025. Here's our February production update. February absolute numbers produced 32,588,000 barrels, while January produced 36,428,942 barrels. February 1.164 million barrels per day, while January was at 1.177 million barrels per day. It's important to note that February is a 28-day month, and so 3 less days than January. Thus, the reason that the absolute numbers are down significantly month over month. The number is 5.8% above revenue forecast of 1.1 million barrels per day, 1% down January to February, or 13,000 barrels per day from January to February. On the gas side, February's production was at 91.52 BCF for the month, or 3.268 BCF per day. January was at 103 BCF for the month, or 3.322 BCF per the day. Negative 1.63 January to February month over month. We believe the slight decrease to be from the slight decrease from January to February being due to the extreme cold spell during the month of February. Moving on to the top oil-producing counties slide, not much change here month over month. McKenzie County still leads the state in production with roughly 30%, followed by Dunn with roughly 23%, then Montreal with 21%, and Williams with 18%. Important to note, top 5 oil-producing counties here make up roughly 96% of the oil production in the state of North Dakota. The following is our rig count by state and basin. The upper graph on the left shows the rig count in the bar chart format by state, and in the lower left is the basin count. Total U.S. rig count, U.S. onshore rig count, stands at 569. 47% of the rigs in the United States are in Texas. The North Dakota rig count is at 32 for the month of March, as it was in February. So that continues to be a steady hold on the rig count number. There's 33 total rigs in the Williston Basin, 289 rigs in the Permian Basin, which is the Texas and New Mexico side of that. So roughly 50% of the total U.S. rig count is in the Permian Basin. There's 38 rigs in the Northeast United States dry gas play. That's the combination of the Marcellus and Utica shale plays. This next graph shows rig count trends over time by state. It's just another way that the DMR tracks rigs, and when there are changes in the rig count, we're able to dig into the reasons why. Again, showing 569 total rigs in the onshore United States. North Dakota's rig count in green in the lower right-hand corner of the graph at 32. The only change that I see month over month on this is a slight increase in Oklahoma activity in the Mid-Continent region, and I'm not exactly sure why that is. The other point that I'll make is that the rig count in the United States has really remained steady since early 2024. Moving on to the next slide, this is similar to the prior graph, but illustrates the rig count by basin. Again, the 569 number right in the middle of the graph is the Permian. Real slight decrease in the Permian rig count. Again, I'm not sure why. We'll continue to watch that to see if that trends out month over month. And the Williston Basin in the lower right-hand corner at 33 rigs. Moving on to pricing. I just checked current WTI pricing before I walked in here, and it was at $64.60. Yesterday, when we built this slide, it was at $63.44. Really highlighting the variable price environment that we're in right now. North Dakota market, February's price was $63.94, or 8.7% low to revenue forecast. January's was at $67.64. So it's a softer price environment than the revenue forecast that the state forecasted. Graph on the bottom shows current rig crew or current frac crew count at 13, consistent with January and February. I'd like to speak just a little bit on pricing. I mentioned that the pricing has been highly variable lately. The 12-month range in WTI ranges from $60 to $85 a barrel, and we're currently near that low, right around the mid-60s. A couple potential reasons for this is that OPEC announced an output increase a few weeks ago, greater than what they had signaled to the market, and there's this idea that the tariffs are being, trying to be understood by companies and how they might be impacting things such as steel costs. I don't believe that the current price levels are rooted in strong fundamentals. It could be more of a short-term thing, but time will tell. And I do expect prices to rebound slightly once all the sanctions and tariffs are better understood throughout the operating companies that work here in North Dakota. Moving on to permits and completions, the permit trend continues to be pretty steady along with that of the completions. March numbers at 94, February was at 90, and January was at 102. On the completion side, March is at 74 completions, with February and January at 79 and 78 respectively. So both pretty steady. This is our well count graph. Total producing wells is down slightly in the state, likely due to the extreme weather conditions that we had during the month of February. I know that I saw negative 38 degrees here in Bismarck, so it was a cold week or two that we had during the month. The number of inactive wells in the state, you'll see in red, continues to be steady right around that 1,750 number. This is a new graph showing completed well footage by year, along with the percentage of completions reported for those years. And really what we're looking for here is the trend in lateral lengths. I've spoke about this in the last couple director's cuts. So you'll notice in blue, that's your total completed lateral length by year. In the black dotted line there in the graph is the number of completions per year. 2025 numbers are certainly incomplete, and they'll just update each month as more data comes in. You'll notice in 2024 that 10,647,000 total feet were completed. And your estimated average lateral length numbers are there on the right in the middle. The other trend that we're seeing is our U-shaped lateral update. Excuse me. We have 12 U-shaped lateral permits issued to date. 2 are completed and online. The following graph is your Fort Berthold activity, and that's 193,278 barrels for the month of February, up quite a bit month over month. I will note that there was amended production reports that were submitted for June 2024 through January 2025. Moving on to the next slide, which is gas capture. State Statewide gas flared volume from January to February increased 0.4 CF per day to 177 million standard cubic feet a day. FBIR Bakken leading the pack in gas capture at 97%. So with that, I'm going to take a break, turn it over to Justin, and I'll come back and answer questions here in just a little bit.
Well, good afternoon, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. We'll get rolling here with the slides. Eastern Montana continuing to, as Nathan mentioned, one active drilling rig over there. So they have seen, fairly consistent increases in their crude oil production here throughout the last 12 plus months. And so you can kind of see that calendar number from 60,000 or so January of 2024 to again over 70,000 barrels per day. So some success over there that we're watching closely, and what type of impacts that might have here on the broader Williston Basin. The month-to-month changes, again, we've got the historical context here as well as the GOR. So another kind of down month on the gas oil ratio that we were seeing. Again, not outside of any norms that we would expect in these ebbs and flows as the basin continues to mature and we continue to see that gassier mixture coming up with this production stream. Some slight changes on how the crude oil is being marketed out of the Williston Basin. We saw a little bit of a downtick on the rail estimates leaving, so a little less than 2 trains per day on average. We'll dive here in a second on where those are headed. That market share was met almost exclusively on the pipeline side. So that's the blue market share component that you're looking at here on slide 23. So again, just on this is just that estimate, kind of the high and low estimates. So you're just over 100,000 barrels per day, somewhere in that 120,000 barrels per day. The destination for those, the latest intel we have from the EIA is that, again, 90+% is heading towards the Pacific Northwest. We did see a very slight uptick down there in the bottom, both in Pad 1, and then we saw some deliveries down into that Pad 3 Gulf Coast market for the first time in over a year. So again, I don't have any reason to believe that that's going to be a trend or that we'll see meaningful volumes headed that way. There's a whole lot of pipe connectivity options for that. I think that was likely just a small marketing decision that was made. Again, prices are going to drive a lot of these decisions. The latest, what we have for refinery acquisition costs of crude oil at these facilities, continued strong pricing over in that Pad 5 region, the West Coast. And then again, that Pacific Northwest in particular, that has shown for many years now to have a very strong appetite for those Bakken barrels. When we look at pricing here, as of earlier today, you've got Clearbrook trading at a discount to WTI, 80 cents below. Bakken at Patoka, a $2+ premium to WTI there. That Brent WTI spread slightly down month over month between that March and April timeframe, but still in that window that continues to drive the economics for any type of flexible barrel, preferring likely the pipeline options out of the region. And then down at the Gulf Coast, again, that spread, again, not hinting to me at all that we would start to see any type of increased rail traffic headed that direction. Again, I think that was more of a short-term blip. This is a new graphic for this event. This is the average discount of what North Dakota was seeing relative to West Texas Intermediate. The last 6+ months or so, I would call that pretty significant discounts from what we had gotten used to in that 2022, 2023 timeframe. So over $7 again in the month of February. We're seeing some market indications that should be improving here as we get into the March, April timeframe. Particularly one of the things I watch is the synthetic crude oil market up in Canada as that enters down into the Pad 2 Midwest refining complex. That has kind of flip-flopped here in recent weeks and starting to trade again back at a premium to WTI. So when that synthetic crude oil does well, there's a correlation between strong Bakken pricing and some of those other Canadian crude pricing markets that head to those same Great Lakes refineries. As we flip forward, nothing really noteworthy to talk about on the imports exports number. On the gas flaring, no changes. It was 5%, and the reasons for that 5% continued to stay consistent. We've seen now for well over 2 to 3 years here of really strong gas capture numbers, hovering between that 4 and 6%, which is again a really strong success story for the industry as a whole, as they continue to stay active, making sure they're getting the well connects done. More good news in February, more wells getting connected to gas gathering, the new wells producing natural gas. So those are all, again, critical indicators that just show continued effort, continued success, making sure that gas makes it to market. On the negative side here, the EIA did give it another haircut to their oil price outlook. As you look forward here, this is another couple bucks off of what we looked at last month. They're continuing, if you look at the bottom right-hand graphic, their implied stock builds now for the next roughly 2 years here. They're expecting an oversupplied global marketplace, demand not keeping pace, and as such, some downward pressure on their oil price outlook. So they're expecting sub $60 in that 2026 calendar year. So we'll certainly keep a close eye on that as we think about the meaning of that for North Dakota. No news on gas processing for today. There is some things that will certainly be noteworthy here as we start talking about residue, natural gas pipeline infrastructure. We're seeing some increasing market share build up here on the northern border system, upper 80s market share for Bakken gas on that system relative to Canadian. So that's, again, something that's going to continue to work its way gradually upwards until next year when we see the Bakken Express pipeline system come online. We'll likely see some rebalancing, and then as production grows, we'll continue to see this ebb and flow. One of the other things that's noteworthy is that even though we've seen some stronger market share, we're continuing to see downward pressure on BTU, which again, for the math nerds looking at capacities, flow dynamics, what's happening at the processing plants. If we see an environment where we want to see more ethane rejection, or the marketplace is pressuring more ethane rejection into that gas stream, that's going to amplify some of those challenges that would come on the northern border system. So right now, this is really a positive thing for capacity on northern border, is that this gas has been dried out noticeably here over the last 6 months, allowing for more gas into that system. So on the WBI Bakken East system, this is something we've talked about, this proposed project. What we haven't talked about in the past, this was announced last week on April 17th. Intensity launched a non-binding open season, which will wrap up May 23rd of this year for what they're calling their phase 2 segment. So if you recall earlier discussions about the phase 1, which is in the purple or the fuchsia colored system on this map, that was originally designed looking at that McKenzie County towards just north of Bismarck, that Underwood, Washburn area. This phase 2 open season is looking to see what type of market interest there may be to continue that system over to the Castleton market. And you can see some of the details here. 208 miles, 30-inch. It was the original proposal here, 430,000 decatherms per day, with the January of 2030 in-service timeframe. So again, just like the last open seasons that we've seen here with WBI and with Intensity, this will continue to work through. They're going to work with customers to look at, again, what level of interest exists. The two different companies will likely continue to compete with each other here in the coming weeks and months to determine, what the marketplace looks like and what project success looks like going forward for one or both companies here. And likely it's going to be, I get asked the question quite frequently, how long before we know what's going to take place? I'm not anticipating any firm type of direction for several months. And so it may be deep into summer before we have any clarity on exactly what these projects might look like and in what shape or form here going forward. So with that, I think I will stop there. There's some questions that came in online, but maybe before that, let's start with any questions in the room for me, and then we can get Nathan back up here for any of the DMR questions.
I guess, what have you heard from like pipeline companies regarding like the tariffs in China for potential tariffs in the future and how that impacts like materials and everything?
Yeah, so there's a few things. So the question was about, tariffs and what that means for the pipeline industry as a whole. Not only from a construction standpoint, you've got the materials piece, but then also just the marketplace. And there were some online questions that came as well. I'll wrap this in. There's a question about US LNGs, propane, ethane, and what some of the global tariffs might mean for that. And so North Dakota, obviously, we sit at the geographic center of North America. So we're as far from any type of waterborne markets as there is. And so typically, North Dakota LNG, North Dakota natural gas, works its way in the Midwest and stays there, and it's other kind of more fringe areas of the continent then that get waterborne and compete in that market space. So if there are things that are happening at the global level that are impacting either higher or lower demand, that's going to impact those Texas, Louisiana, the Canadian volumes first, but then North Dakota will be a reactionary piece in that puzzle as it works to either backfill or push its way into other markets as a result. So directly, I'm not aware of any meaningful volumes of North Dakota LNG. I'm not sorry, LPG or ethane that's getting on the water, but it will react to the North American market that then is reacting to what's happening at a global level. So on the material side, certainly, folks looking for, clarity, looking at, bids and taking a look at how long they can rely on certain pricing components. I've talked to some suppliers where they're able to hold pricing for 24 hours, just with some of the uncertainties. And so there's decisions that need to be made either quickly, or there's a level of uncertainty then going forward of what supply will look like and what some of those pricing dynamics will look like. I don't know if did that answer all your questions? Fairly.
Yeah. Uncertainty. Yeah. Is there any like specifics on any type of material that's being impacted? Or
no, as we look and there's a number of exemptions that exist too, even with Canadian and US trade, and I'm not going to pretend to certainly be an expert on what qualifies for certain exemptions. So there's just trying to understand exactly what's in place, what the timing of that is, what specific materials, because there are some exemptions for energy related tubular products and how that's all playing in. So I think folks are just working to just better understand the landscape here. Dave, any questions?
Yeah, I was just thinking about the WBI and intensity.
Mm-hmm.
There's a lot of industry sources say that they need, to have a good customer who's going to be around for a long time for them to build it. Are you getting any indication that there are those customers out there?
Yeah. So the question was, what's kind of broadly out there in the demand side for the two various natural gas projects that I mentioned. I think it should be a really positive sign that now there's two projects competing for the same type of markets, which should say that there's a fair level of confidence that a market does exist with the type of customers that are looking for long-term reliable supplies of natural gas, whether that's for power generation or various industrial applications. So I think very encouraged by what we're seeing and hearing out there. It's just going to take a little time to work through the commercial side of it.
Could both be built?
Theoretically, yes. There's nothing that would stop both projects from being built. It's probably more likely that if we're looking at kind of that eastern half of the systems, my gut says that's probably more of a one pipe market. There may be opportunities for more than one pipe on that western half, but again, that'll be for the marketplace to dictate.
Is there anything you can tell us about Keystone and how that might impact it?
Oh, yep. So good question. So the Keystone Pipeline, the spill, the shutdown, and the restart. So the Keystone Pipeline, no North Dakota crude oil enters or interfaces directly with the Keystone Pipeline in North Dakota. So when that system did go down, that did not have any direct impact to North Dakota production. or our ability to move oil out of the Williston Basin. So that was a positive for the upstream community. So with the restart of it, obviously that system flows 100% Canadian. So that was more of a Canadian dynamic when you look at just the commercial sides of it.
So no, or that shouldn't mess with too much pricing, you would say, especially for us here in North Dakota.
Yeah, good question. So the question was on the pricing side of it. So I'll have to look back at the data if there were any ebbs and flows. I didn't particularly notice anything, real meaningful. That the restart came, I think, probably as quickly as they could have safely done so. So I think that was a positive to make sure that there weren't any major market disruptions on that front. So what other questions here before I turn it back over to Nathan? So some questions here on rising gas oil ratios and field condensate production, and heater treaters, and the ability to manage rising GORs from a vapor pressure consideration. So the pipeline systems, whether it's DAPL or others, they have certain chemistry specifications that are required of those barrels that get delivered. DMR and Nathan and his team can comment more on the crude stabilization front and the vapor pressure requirements that they have in place at their office, but I'm not anticipating any type of constraints in our ability to move oil as a result of vapor pressures. I think that's being managed fairly well at the wellhead itself. If things change over time and there is a market need for higher volume stabilization facilities, I haven't seen anybody going that route, but that's always another option out there. And then there's a comment here about diluent demand in Alberta. So Cochin Pipeline is another system in North Dakota that travels from the Chicago Midwest area up into Alberta. There has been in the past, I'm not sure what the latest numbers, there is a truck loading facility in North Dakota to put some heavier NGLs into that system for diluent. But again, it's a pretty small fraction when you look at the overall volume of NGLs that get produced in North Dakota. So I'm not seeing any market projects or market-driven projects to move more or growing volumes of North Dakota NGLs into Alberta for diluent. So with that, I think I've answered all the online. Anything else in the room before I turn it over to Nathan?
We actually just did get
Oh,
another
okay.
question online. How is
Do you want to? Yeah, all that. And I guess there was one more question on renewable natural gas, correct? Yes. Any RNG renewable natural gas projects planned under construction in North Dakota? Yes. So there's a few. The North Dakota Industrial Commission last fall funded a few projects. There's one in Carrington. There's one at American Crystal Sugars in Hillsboro. There's another up at the University of North Dakota with what they call their sandwich technology. And so those three projects last fall got some Industrial Commission funding for some pilot and some research. One long-standing RNG project in North Dakota is the Fargo landfill. They've for many years, even when I was in college, I remember seeing the facility over there where they're capturing landfill gas and using that for fuel. And so those are the four that I'm aware of. There's others, certainly, obviously, always looking at North Dakota for opportunities. I think North Dakota could be a major producer in the future. And so if there are companies watching this and looking at opportunities, certainly our Department of Commerce, the Industrial Commission, and on the whole, get in touch with any of those parties. We'd be glad to talk with you a little bit more about that. So, okay, we'll turn it back over to Nathan. Thank you.
Thank you, Justin. All right, we had a couple questions come in online. I think this one here also addresses the one that came in online, but it was, does DMR have a sense or a range of break-even WTI prices for a typical Bakken well today? I would just say that we've had a lot of discussions with operators on this recently, but the answer is specifically the DMR doesn't perform its own calculations on this because we don't have all the inputs needed to make that calculation. For years, I've been following break-even prices in all the major basins across the United States, and typically, the Bakken, a good number would be in that $50 to $60 range. But I really want to caution everybody on using that and taking that number to the bank because it's highly variable based on, what formation, whether it's the Bakken, the Middle Bakken, the upper Three Forks, the lower Three Forks, the Red River, or another formation. So it's really a highly variable number. Also, companies continue to advance technologies all the time. We've seen that in North Dakota with 3 and 4 mile laterals, and most recently we're seeing U-laterals. So technology plays a pretty big impact into that as well. So I would say that $50 to $60 range seems to be a decent number. Did it say another question regarding price, or was that kind of the same?
Yeah, it's kind of relating to break-even prices. While oil prices are so low, do you anticipate production to fall in the future?
That's a good question as well, and that just follows industry activity. Whether there's I would say, we're seeing longer laterals with less drilling rigs, less frac crews, and production is remaining relatively steady. If we drop 10 rigs because pricing remains in the low 60s, although I don't expect that to happen based on the comments, the reasons that I stated in my comments earlier, but it's really just a function of activity, and I don't really think the price environment that we're seeing right now is fully rooted in fundamentals of supply and demand. There's a lot of probably companies that are trying to figure out what tariffs mean to their cost of goods and services, along with sanctions. OPEC came out, and I think they indicated to the market that they were going to increase output by 160,000 barrels. They came out a few weeks back and increased output 440,000 barrels, which I thought was supposed to occur because of the sanctions on Iran and Venezuela. So again, there's still kind of a lot of noise in the system, and I think that's going to work its way out over the next few months. So I think that answers that. Another question that we got on was at what price point and for what duration at that price point would you expect to see operators dropping rigs and frac crews or adjusting CapEx plans? And that's again a good question. I think we sort of answered that. I'll give you a few items that I think companies consider when making those decisions, and that's how they're financed. The procurement piece for their goods and services that I spoke about. Well, what their net revenue interests are, pricing, operating cost, and the list goes on and on. But I would say, it's likely that all companies, as prices dipped into the low 60s, that all companies are talking about that and probably going to their service providers asking for cost reductions. And then I would just say the opposite of that occurs when prices go up and they're high. So service providers come back to operators and typically ask for cost increases. But again, I think hopefully we're in kind of this price dip. And it's relatively short-term market influence as the market understands where the impacts to the tariffs and the OPEC recent announcement. Another question was, are you expecting to see a substantial DUC buildup this year? And we're not hearing any consideration of a large DUC buildup. We have heard that there's potential for 2 rigs to be dropped in 2025 as part of normal planned budgets decisions that were made prior to the recent price dip. So that's really all we've heard there. Typically, if companies wanted to pull back their capital plan quickly, they would keep their any. To the without giving Dave, I'd like to get that to you offline. I have 3 or 4 slides that are prepared for the legislators on that. So
At least one legislator on the floor talking about Senate Bill 2397 said that he's concerned that oil companies might be ratcheting back production so they can avoid and go to stripper well status and avoid taxes.
yeah.
Is there any evidence of that?
No, I would say that no oil company wants to necessarily go into stripper well status. It probably doesn't take much of an oil price increase in order to accommodate for the difference there. So I would say that They definitely don't want that. They're optimizing production all the time, from my experience. And this information that I have, I can share with you as well.
And on Senate Bill 2397, did you help write that? The hog house?
I did not write or help write Senate Bill 2397, but that's one of the bills that we're actively participating in, offering our comments and opinions, as the certification of those type of wells would fall in the hands of the Industrial Commission, is the way the bill's currently.
Do you think it's a good idea?
I have a lot of thoughts on that, and we're working through those right now.
Okay.
Yeah.
Fair enough.
Yeah. I think the concept of looking after or looking for new technologies to increase production in the state is a great idea. What I can't really comment on is because I actually don't or haven't seen any numbers. I can't comment on what impact a full tax exemption on those barrels would really mean to the state. So I just don't have the data on it in order to comment intelligently about that right
That's fair
now.
enough.
Yeah.
Could you go over some of those like fundamentals you talked about for the price point and like when you sort of expect the market to go back to where it should be?
Yeah, I mean, it's a process. So oil price drops. The first thing, I've had to do this in my prior career before joining the state. But first thing you do, you start talking to your teams about, where can we find efficiencies? What are some of the things that have been nice to haves but not necessarily need to haves? What are the what service providers can we get cost reductions in? Then you really see where you can get with your capital costs. You of course start working your operating costs at the same time, which is just those day-to-day costs for operating your wells. And then every company's finance different. There's a different weighted average cost of capital for each company's capital. One company might have a higher net revenue interest than another company. So it's a relatively complicated process that goes through lots of iterations in order to come to the answer on whether an operator keeps a rig running or not. The other might be North Dakota might be the only basin that operator is working in. And another company may have 15 different assets around the world or the United States to put money in, and then they're looking to really high grade their economics during times lower price. But again, I think current prices again aren't totally rooted in fundamentals right now. I believe we've sanctioned Iran and Venezuela to roughly 2.5, maybe 2.75 million barrels a day. And OPEC announced a 440,000 barrel increase. And so that tells me that there's still a lot of things to work out, uncertainty with tariffs and whatnot.
Could tariffs, like, have you seen any situations where like these impacts the trade, impacts other aspects of the economy? Like, could that just eventually dampen activity, or is it too short restraint?
Usually, I mean, there's a demand every day in the world of about it was a 30% reduction almost immediately down to 70 million barrels a day. Well, that's not happening right now. I would say, inflation, we're still at 103, 104 million barrels a day. Supply and demand. So the market or the industry needs to fuel that somehow each and every day. So it takes a pretty massive situation for it to go away entirely.
How do longer laterals affect that price point in terms of like breaking price?
But it should increase their break-even prices. I'm sorry, decrease their break-even prices.
So the extra money they spend doesn't.
Yeah, it's just a better capital efficiency. So they're gaining more production for every dollar that they're spending.
Last question. What's sort of the status of some of the IIJA funding for like cleaning up old oil spills, all that?
Yeah, Mark may be able to speak a little bit better about this, but the initial grant is essentially done. There's just a little bit of carryover dollars that we're asking for, or that we're moving. We're going to use for the remainder of this year. That's very little. I'm talking less than maybe less than $100,000 of the original grant. The state has been offered all states have really been offered the formula grant funding, and we're working through all the stipulations that it takes in order to achieve that funding. So there are certain things that are being asked for by the federal government in order to utilize those dollars, and those are things that came about during the prior administration, and we're patiently waiting to see if some of those things can might ease up on some of those restrictions.
Does that run through Interior, or what department does that?
Department of Department of Interior.
Yeah.
Thank you. Yeah. All right. Any other questions?
Here.
All right. Thank you. That's not DOE, right?